Very good evening, everyone. Welcome back to one more interesting session of financial management. Today, we have this session dedicated towards the revision of the previous two topics, right? First of all, how are you all? Everything's good? All your preparations are on track, right? Okay, so as I can see, there's a immediate query that I have. Okay, so the query says, I have one doubt from previous class regarding arbitrage process example. Why we calculate income receivable investment after switching on the amount of PAT which is related to before switching. Because if an investor will invest in another company, then that company has equity and debt value will change. No, Shreya, equity and debt value of the company is not going to change because it's a listed company. It's a publicly listed company. So you're going to buy from the market. You're not going to buy new shares of that company, or you're not going to get debentures newly issued for yourself. Okay, so therefore, the total number of shares and the debenture of the company is going to remain constant. Anyways, in the capital structure itself, we had that assumption that the total capital remains same, right? Okay, so right now, in the first half of our session, we will focus on the ratio analysis, revision part. We'll do some questions, some from module, and maybe one or two from the handout. I think the practice question 2 we'll be doing, and some things that we are left yet to cover over there, especially the Dupont chart, right? So let's just begin with it. Let me just come up with that part. Yeah, fine. We are good to go. Now, let's quickly recap the ratios and then we'll do some more questions. Okay. Now, we have seen that for financial analysis of any company, we need to look at certain numbers, and those numbers are the ratios or the percentage. So, ratios can be broadly categorized into these types of ratios, basically liquidity ratio, leverage ratio, activity ratio, and profitability ratio. So, liquidity ratio talks of short-term solvency, leverage talks of the long-term solvency, activity ratios, it indicates how efficiently we are doing our business. Profitability ratios tells us what is the return on investment that we are generating. The first ratio that we did was current ratio. We stated it to be current assets upon current liabilities. And that indicated that for every 1 rupee of every rupee of 1 rupee of current liability, how much current asset did we have, right? And we said that higher the current ratio indicates better liquidity position. However, that does not mean that very high current ratio is a very good thing, because very high current ratio indicates inefficiency with regards to sale, collection, and investing. So ideal current ratio is 2:1. But then we saw that in spite of doing that, we may face a situation that in spite of having a ideal current ratio of 2:1, we may face a situation that we are not able to honor the payments of our creditors, right? So basically, that's the shortcoming of our current ratio. And therefore, we said that in current assets, these are the two assets, especially the stock and the prepaid expenses. These are the two assets which are not useful in settling the liability. So we removed them, and therefore we computed quick ratio or acid test ratio, or also called as the liquid ratio, which is quick assets upon current liabilities. Now, what do we mean by the quick assets? It was current asset minus inventory minus prepaid expense. Okay. Then cash ratio. Cash ratio, it was about absolute liquid ratio upon the current absolute liquid assets upon the current liabilities. Now, what do we mean by absolute liquid assets? It means cash, bank, and marketable securities divided by current liabilities. Okay. Now, to check whether we have sufficient cash or not, for that we have basic defense interval ratio, and of course, higher the better was the funda over here, right? So cash and bank. So what do we have in the basic defense interval? In the numerator, we have the amount of cash or amount of funds that we have got, and those funds are like cash and bank, marketable security, and net receivable. Net receivables divided by operating expenses per day. So it will give you how many days expense do you have. So daily operating expenses is COGS plus selling expense plus general expenses minus depreciation minus any amortization expenses divided by number of days in a day. Okay. Then we learned about some of the long-term ratios, long-term liquidity ratios, one of which was equity ratio, which stated what proportion of net assets is funded by shareholders. Debt ratio, which indicated what proportion of net assets is funded by the debenture holders. Debt equity ratio was the ratio between the debt and the owned funds, that is owned funds and the borrowed funds. And capital gearing ratio was indicating what level of gearing are we having in the business of our entity. So capital gearing ratio, it was like funds which require fixed return upon funds which do not require fixed return. So in the numerator, we had preference share capital and debt divided by equity share capital, reserves less fictitious assets. We have also seen what is capital gearing. Capital gearing is basically taking debt at a lower rate and investing it at a higher rate of return. Then how do we measure the ability to repay the dues? For that, we had this interest coverage ratio, in which we saw that it indicates how many times of our interest is EBIT. Preference dividend coverage ratio indicates how many times of the preference dividend is PAT. And fixed charge coverage ratio is EBIT plus depreciation upon interest plus principal repayment, because we don't have to just repay the interest every time, we need to pay the principal also. Debt service coverage ratio is also on the similar lines, which talks about earnings available for debt service upon interest plus repayment of principal. Now, what is the earning that is available for debt service? That's basically PAT plus non-cash operating expenses plus interest plus or minus any adjustment. This interest is added because when we computed PAT, we would have deducted interest. So what funds do we have in our hand? The operating funds that we have generated, that is what we consider in this debt service coverage ratio. Then how to identify whether a company is doing efficiently, if a company is utilizing efficiently its assets? For that, we have all these turnover ratios, and all the turnover ratios are having the same format, which said in the numerator sales or COGS, dividing it by the total asset. Now, total asset means your fixed asset plus current asset. Fixed asset turnover, you had only fixed assets. Net asset turnover or capital turnover, that will be just total assets minus current liability. Same way, current assets turnover, working capital turnover, everything the format is same. In case of turnover, it's always going to be sales or COGS in the numerator, and in the denominator, the respective item. Inventory or stock turnover ratio. Now, this indicates inventory or stock turnover, tells you how many times one lot of stock will be sold in a year. So higher the better, right? So this is higher the better. And also, it also told us how many months would be required to sell a lot of stock. That is like inventory holding period. And inventory holding period is like lower the better. Okay. Okay. Then we have the next ratio as the receivables turnover ratio. Now, receivables turnover ratio was also telling us how many times in a year are we selling the goods to our debtors. And in terms of months, it used to tell us what is the time period we take to collect money from the debtors. And the same funda was going for even the payables turnover ratio. Now for that, to check whether the company is generating adequate profits, we looked at some of the profitability ratios, and those profitability ratios were depending on what sort of uh, comparison we are doing. So profitability ratios were on the basis of sales, on the basis of return on investment, return to the owners, and based on the markets or the overall investors. So first set of profitability ratios that we see was GP ratio, then we saw net and NP ratio, operating profit ratio. All of them are having the format of that particular number divided by net sales into 100. Okay. Then expense ratio, we say COGS ratio is like COGS upon net sales into 100. Operating ratio is your operating expenses plus COGS upon net sales into 100. And any other such P&L ratio is also going to be on the similar line. Okay. Now, how do we measure the return on investment? We know it is return upon investment into 100. And for that purpose, we said that return on investment can be classified as into three different can be understood from three different perspectives. One, what is the return that we're generating on assets? What's the return on capital employed? And what's the return on equity shareholders? So on assets, we say what percentage of return are we earning on the investment in assets? And in similar case, in case of capital employed and in case of equity shareholders. Now, we also saw the income statement in which we stated that EBIT is an income for all investors, PAT is an income for owners, and net profit for equity shareholders is the income for equity shareholders. Okay, we have seen this ratio. Then we have seen some of the market ratios, which was earnings per share, dividend per share, dividend payout ratio, retention ratio. Dividend payout was what percentage of your earnings you are paying out, and retention ratio is what percentage of earnings you are retaining it with yourself. Then we saw a price to earning ratio, which indicated the level of confidence that the investor has on the company. Dividend yield is the percentage return in cash term, that is dividend as a percentage of your market price, and earnings yield is a earnings as a percentage of your market price. Okay, now we have some more ratios that we are yet to discuss. One is the market value to book value ratio, Q ratio, and then the Dupont chart. So let's do these three things first, and then we will go for some numericals. Now let me take some queries if there are any. Mansha is asking, in financing decisions, is it necessary to consider market value only? Mansha, yes, market value is to be considered. Hiral is asking, why do we not take EBIT in debt service coverage ratio in numerator? Hiral, in debt service coverage ratio, we look for how much cash we have generated. Okay, so we don't consider EBIT because in EBIT there are some non-cash items also, like you would have deducted the depreciation. So depreciation part needs to be added back because that is not what you're paying in cash, right? So for debt service coverage ratio, we consider what is the cash flow that we have so that we can repay our bankers. Then Annie is asking, please explain what's the marginal cost of capital using numerical example. I think cost of capital will have a separate session. Quasi-equity bonds. Mansha, quasi-equity bonds are basically type of debentures, sort of unsecured debentures, you can say. Unsecured, which is issued to the owners of the company. As I've told you, promoters' contribution in our session of sources of finance, there I've told you something about quasi-equity. So this is the loan provided by the owners to the company, or the loan provided by the equity shareholders to the company without any security. Okay, fine. So I think I have covered all of it. Now, market value to book value per share. Now, what is this ratio, guys? Market value to book value. Let's have a look at it. Here, the ratio says that market value to book value simply means market price per share upon book value per share. So this is market value per share upon book value per share. Now, how do we get the book value per share? Book value per share. So for that, let me just put up a balance sheet in front of you guys. With this balance sheet, you'll be able to understand this concept of book value per share. Okay. Let's say in this balance sheet, the company is having fixed asset and current assets. Fixed asset is 1 crore, current asset is 50 lakh. And company is having payable debt of, let's say, 40 lakh. So can you tell me how much will be equity share capital and reserves of the company? Can you tell me how much will be equity share capital and reserves of the company? How much will be equity share capital and reserves of the company? Yep, yep. It should be 1 crore 10 lakh, right? Mm. 1 crore 10 lakh, right? Uh, So equity share capital and reserves is 1 crore 10 lakh. Now, if I tell you that this company has got a equity share capital at rupees 10 each, uh, equity share capital stands as, let's say, 40 lakh. Okay, so equity share capital stands as 40 lakh and reserves remain as the balance 70 lakh. So total it is 1 crore 10 lakh. Okay, the equity share capital 40 lakh, reserves is 1 crore 10 lakh. Now, if I ask you, this is the total net worth of the company, right? This is the total net worth of the company. And if I ask you, what is net worth per share? Can I say, you say, sir, it is 1 lakh, sorry, 1 crore 10 lakh divided by 4 lakh. 1 crore 10 lakh divided by 4 lakh. Net worth per share is 1 crore 10 lakh divided by 4 lakh. So that works out to be how much? 1 crore 10 lakh divided by 4 lakh is 27.5. So per share, we have a book value of, per share, we have a book value of 27.5, right? Yep, correct. So per share, we have 27.5 as the net worth per share. Net worth is owned funds, or I can say owned funds, which are brought in by the owners of the capital, owners of the company. The net worth or owned fund per share. The total owned funds which is invested in the company is 1 crore 10, and against that we have 4 lakh as the shares. So for each share we have invested like 27.5 into the business, and this same share is being traded in the market at a price of, let's say, 40, or maybe at a price of, suppose, yeah, 40, or maybe let's say 44 rupees. So obviously the share is trading in the market at a premium. As per the books of accounts, the value of the share should be 27.5, whereas the value of the share in the market, in the actual market, the value of the share stands as 44. So of course it's at a premium, and when I want to compute it, this is going to be 44 divided by 27.5. Right? So if you divide this, this will work out to be 1.6, or this 1.6 indicates market price of share is 1.6 times of book value of share. So as per the books of accounts, against the books of accounts, the market value of the share is 1.6, is 1.6 times. So is it a good thing or is it a bad thing? Is it good or bad? Book value of the company is 27. In the books of accounts, the value of the share is 27.5. And the same share is being traded in the market at a price of 44. That is at a premium. Is it good or bad? Yes. Is it good or bad, guys? It's good. Definitely it's good because the company is having a good value in the market as compared to book value. In the books, it may be just 27.5. It means we can say for every share, the company is having 27.5 asset. But in the market, the people are assuming that the market price is higher, or people are assigning a higher value to the company. So maybe the company's future potentials are good, and therefore we find that the market price is higher. So here also again it says market value to book value is again an indicator of investors' confidence. So higher this ratio, higher is the investor confidence on it. Okay, higher this ratio, we say higher is the investor confidence on the company. That's the book value to market value to book value share. Okay, there's another ratio called as Q ratio, somewhat similar to the book, market value to book value ratio, but here it says market price of all shares, that is market value of company, market price of all shares, that is market value of company, divided by replacement cost of its asset. Replacement cost of assets. Okay, so let's try to understand it. Let's say overall value of the company in the market, that is value of all the shares of the company, stands as 1 crore. Okay, and I say, sir, if I want to have a similar company, if I want to create a similar company today, if I want to create a similar company today, I need to replace its assets. So if I want to replace these assets with similar assets, it would cost me, let's say, 50 lakh. So value of the company in the market, that is, if I want to buy the shares and debentures of the company, I need to pay 1 lakh. And if I want to create a similar company right now with similar set of machinery, computers, furnitures, factory building and everything, it would cost me 50 lakh. So market is assigning a higher value than what the replacement cost of the assets is. Right? So again, tell me, is this a good thing? Is it a good situation, favorable situation or unfavorable situation? Is it a favorable or unfavorable? Of course, it is, a favorable situation. This is definitely favorable. And just to give you an idea, the 50 lakh, instead of 50 lakh being the company ka replacement cost, the market is assigning 1 crore as the value. This means people are ready to pay 50 lakh more for the company because of its goodwill, because the company is having a goodwill, because of its potential to earn future returns. People are ready to pay more for this company. Therefore, this Q ratio is again a measure of investors' confidence. Okay. How market value is calculated? Shreya, market value is never calculated, it is observed from the market. You cannot calculate a market value. Market value is what you observe. If you go to market and just ask any vegetable vendor that, show me how have you calculated the market value, what will he say? He would simply say that this is what is prevailing in the market. If it is 40 rupees per kg, it's going to be same throughout the market because of demand and supply. There's no calculation in it. It's not higher cost. This is the value of the company. 1 crore is the value of the company. And 50 lakh is the replacement cost of the company. Mancha, unlisted company cannot be, these ratios are not applicable to unlisted companies. Karthik, net worth is the owned funds that we are talking of. Owned funds means equity share capital and the reserves. Look at any company balance sheet, you find equity share capital and reserves. That's what you mean by the owned funds. The equity share capital reserves totaling up, that is what we say as a net worth or proprietary funds. Okay, fine. So these two were the ratios, the smaller ratios that we were we discussed, that we had to be discussed. We have seen this right now. So one was market value to book value ratio, and the other is the Q ratio. Okay, fine. Now let's go for Dupont analysis, a very interesting part. Dupont analysis now. If I ask you guys, there are two companies A and B. Return on equity of both the companies stands as same 20%. Looking at just return on equity, let's say if I want to ask you which of the two companies are doing really good, you will say, sir, both of them are doing good because both of them are generating a return on equity of 20% itself. Right. But I want to go deep into the company's financials and I want to know whether the company is really doing good in some aspects or is it like somewhere good and somewhere bad. So that depth analysis is what we call it as a Dupont analysis. Okay. So let's look at the Dupont analysis. What does that mean? And how is that analysis going to help us? Now, we know return on equity. Return on equity is computed as Return on equity is computed as profit after tax upon equity shareholders funds, assuming no preference share. Okay. So this is no preference share capital assumption. So return on equity is PAT upon equity shareholders fund. Now, if I ask you, sir, I want to improve my return on equity. I want to improve my return on equity. For that, we know that I need to earn greater profit after tax. If I want to improve the return on equity, if I want to provide greater returns to my equity shareholders, I need to improve upon the profit after tax. Now, my question to you is, what can you do to improve the profit after tax? What can you do to improve the profit after tax? What can you do to improve the profit after tax? You can be doing two things. Either of these two is going to help you to improve your profit after tax. One is the sales margin should be increased, or quantity of sales should be increased. Am I right, guys? Everyone agrees with me? That, sir, if I want to improve my profit after tax, I need to, if I want to improve my profit after tax, I need to either increase the profit margin per product. Every unit that I sell, I need to improve upon. I need to improve the profit margin on, right? Or I should sell more and more quantity, right? All of you agree with me? This is the only way by which I can improve my profit after tax. Yes or no? Yes, so correct, fine. So now, when you say that if you want to improve your return on equity, you will improve your profit after tax. You will improve your profit after tax, and you will, to improve that profit after tax, you will increase your sales margin, or you will increase your quantity of sales, right? Now, don't think of altering the equity share capital as of now, as it is. Don't think of altering the capital employed. We'll come to that at a later point. But right now, I can say, sir, to improve the return on equity, I need to improve the sales margin or the quantity of sales. Now, how do I go about improve? How can we improve this sales margin, or how can we improve the quantity of sales? So for that, let's look at so PAT upon equity shareholder. I can actually split it into two parts. Right? I can split it into two parts. One is due to the sales margin, and other is the quantity of sales. One is basically the sales margin, and other is the turnover. Okay. So sales margin, I can compute it as upon sales, and I will say PAT upon sales. And if I want to think of quantity of sales, that's basically the turnover. So when we say turnover, it means sales upon equity shareholders funds. Sales upon equity shareholders fund. So we can say the return on equity is a function of sales margin and turnover ratio. Right? So this sales upon equity shareholders funds, it tells you how efficiently your equity shareholders funds are being utilized to generate the sales. This indicates how efficiently you are utilizing the equity shareholders funds to generate the sales, and this component tells you the PAT. Okay, so now the question arises, what is the use of this? This is used for further analysis. Let's say if I tell you for company A, the return on equity is same 20%, right? Return on equity is 20%. But I say that this 20% is derived as 20 lakh upon 1 crore. Okay. And that I am going to split it further, and I find that so 20 lakh is the PAT upon a sales of, let's say, 200 crores. And this is like 200 crores divided by equity shareholder funds of 1 crore. So that's like, sir, my PAT margin works out to be maybe 1%, because that's like 20 lakh divided by not 200 crore, but it has maybe 20 crore. 20 lakh divided by, that's 1%, right? 1% PAT margin. And this is like 20 times. And there is another company B with the same return on equity as 20%. That 20% works out to be like 10 lakh divided by 50 lakh. And here also we just distribute it as 10 lakh divided by, let's say, 2 crore. And this is like 2 crore divided by 50 lakh. So this works out to be like 5% and 4 times. So 5% is the PAT margin and 4 times is the turnover ratio. Okay, so we're just decomposing the return on equity into two components. We have decomposed the return on equity 20% as, so I'm getting in case of company A, we are having a profit after margin of 1%, and that 1% I am earning 20 times. I am earning 20 times, right? So 1% margin, I am earning 20 times because my turnover is 20 times of my equity share capital or equity shareholders fund. Another company B is having 20% margin, same 20% return on equity, but we say that our profit after tax margin is 5% and that we are earning 4 times. So with regards to profit margin, which company is better? And with regards to turnover times or number of times being sold or quantity or the sales value, which company is better in regards to that? My question is, which company is good with regards to profit margin and which company is good with regards to the turnover? Yeah, tell me guys. Meanwhile, I'll just take any queries. Karthik is asking, sir, how quantity of sales is sales upon equity shareholders fund? See, quantity of sales was like, it's a proportion, na? Sales divided by equity shareholder, and sales would be like sales in sale price into quantity. The quantity is imbibed into this because higher the sales, higher will be the margin. Okay, so with regards to margin, which one is better? Of course, sir, with regards to margin, company B is better. Right? With regards to margin, company B is better. And in turnover way, we can say it is company A which is doing good. Right? Right? So company A is good with regards to profit margin, and it is company A is good with regard to the turnover times. So just think, if somehow company would be able to generate instead of 1%, 2% profit. If company reduces some of its cost and tries to attain the PAT margin of 2%, if it tries to attain a PAT margin of 2%, can I say it will do really very well as compared to company B? Just think of it that instead of 1, if it tries to earn 2%, can I say automatically the return on equity will become 2% into 20, which means 40% will be the return on equity, right? So just a small trigger to company A, we can suggest the company A that please focus on reducing your costs, or maybe try to increase your sale price by some amount, some minor amount. That will lead to outstanding results with regards to the return on equity, right? And for company B, we can suggest them that you start increasing your turnover because you have a healthy margin. You can start spending on advertising expenses and try to attain more and more sales with the same amount of capital. That will lead to increase in profit of the company. Okay, so that's the Dupont analysis that we are talking of, guys. The Dupont analysis is basically breaking down the return on equity into different components and suggesting the companies as to what should be the best course of action for them so that their return on equity margins are really good. Yep. Right, guys? Yeah, so that's the Dupont analysis, which where we are breaking uh, the return on equity component into two parts. There's another part for this Dupont. Okay, so this case, the Dupont analysis, and as we did Dupont analysis, we can actually break it up into three components. One is definitely the profitability component. Second is the turnover component. So profitability is for every unit you sell, what percentage do you have? That should be like PAT upon sales. The turnover will be how efficiently you're utilizing your assets, so sales upon assets. And one more impact we can give over here is equity multiplier, or this is also said to be the leverage effect. Okay, so that's into assets divided by equity shareholders funds. Okay, so this indicates PAT upon sales. It tells you what percentage of sales is profit. Sales upon asset, it tells you how many times of assets is sales, and over here the ratio is basically asset to owned funds. Okay, let me just help you understand this, grasp this better with the help of some numbers. Let's say profitability margin for every, with regards to profitability margin, for every, let's say we have a sales of 10 crores, and on that 10 crores, we are able to generate profit after tax of 10 lakh sales, profit after tax of 2 lakh, maybe let's say just 20,000. So that works out to be merely 2% as our profit margin. But then, sir, sales upon the total assets, which is 10 lakh being the sales, and we have the asset of just 5 lakh in our business. So by using 5 lakh assets, we're able to generate 10 lakh of sales. So that means this is into 2, which means 4%. 4% is the margin that we are generating on the assets. Because remember, asset that we have is 5 lakh. So by putting assets of 5 lakh, we're able to generate 20,000 profit. It means 4% is the return that we are generating on our assets. But then, sir, these assets are not fully funded by the owners. we say, sir, assets are 5 lakh, but out of that we say only 1 lakh is the equity shareholders fund. So you will say this multiplied by 5 times, so into 5, which is 20%. 4% into 5 is going to be 20%, right? Yeah. So just remember this 5, it multiplies your return. Whatever return you have, that gets multiplied by this 5. And therefore, that's the equity multiplier. And this is also a leverage because assets upon equity share capital. See, 5 lakh divided by 1 lakh when we say, the 5 lakh is total assets. 1 lakh is equity. So what about the difference of 4 lakh? The difference of 4 lakh, is basically the borrowed funds that you have. Right? So difference of 4 lakh is simply the borrowed funds that you have in your business. And therefore, we say that it's a leverage component. Okay, guys. Yeah. So that's the Dupont part in which we go for 3 layers of understanding. One is what is my profit margin. Second is how many times of that profit margin I'm earning. And third is how many times the equity is getting multiplied. The equity multiplier is how many times of the profitability and turnover. Okay. Now, I want you to tell me which module question should I be solving for you. And if you are not in a position to tell, then I'll take up the questions. Because I first want to give you the priority. Tell me which module questions do you want me to solve, guys? Which module questions do you want me to solve? Yep, tell me. Let me just try to bring the module questions for you. Yeah, here we have the module. Tell me which question shall we solve? Okay, test your knowledge of module. Exam questions, RTPs. Okay. Test your knowledge questions of the module. Second question which I have sent was that uh, this one, the second question, question 3 from module. Have we solved this question, guys? Because I think this has a solution. Have we solved this second question? Because the solution of that is there over in the module, the notes that I have shared. Yes, we solved it. Right? So we have a solution for that. Okay. Okay, so question 3 from module A is what Viral is asking for. Question 3. This one? Just your knowledge, question 3. Okay, fine. We'll do it guys for you. Question 3. So question 3 says, following accounting information and financial ratios of PQR Limited related to the year ended 31st March 2021. GP is given, net profit is given, raw material consumed is given, direct wages are given, stock of raw materials is given, stock of finished goods is given, debt collection period is given, and some financial ratios as fixed asset to sales, fixed asset to current asset, and current ratio is given. Long-term loan to current liability, share capital to reserves and surplus. Value of fixed asset as on 31st March amounted to 26 lakh. Prepare a summarized profit and loss account and balance sheet as on 31st March 2021. Okay, guys. Fairly simple question. Let's start with the solution. Yeah. First and foremost, what we have is the gross profit information. Gross profit, they say it's 15% of sales, and further they say raw material consumed. All these are percentages. Look for, whenever you have these sort of ratios, always look for some information which tells you about certain number. So we have this, see, value of fixed asset on 31st March 2020 is 26 lakh. Fixed asset at the beginning, it is 26 lakh, right? Do we have any ratio with regards to that? Yes, sir. Fixed asset to sales is 1.3. That is the only way in which you can solve it, because looking at only ratios, you cannot compute the balance sheet and P&L. For balance sheet and P&L, we need to have some starting point as some number, which is 26 lakh. And for this 26 lakh fixed assets, we have this sales value of 1:3. Right? Okay. So let's use that first ratio, which is question 3. We'll use the ratio of fixed asset to sales. Fixed assets to sales. That is basically 1:3. The fixed asset is 26 lakh. On sales is 1/3. So from that we get the value of sales, guys. So sales will work out to be 26 into this 78 lakh. Okay, sales is 78 lakh. Now connected with sales, you find a lot of numbers over here. See, now we are going to compute a lot of numbers using these sales figure, right? We have first number is the gross profit, which is 15% of 78 lakh. The gross profit will work out to be 15% of 78 lakh. 15% of 78 lakh will work out to be 15% of 78 lakh. 15% of 78 lakh will work out to be 15% of 78 lakh. 15% of 78 lakh will work out to be 15% of 78 lakh. 15% of 78 lakh will work out to be 15% of 78 lakh. 15% of 78 lakh will work out to be 15% of 78 lakh. 15% of 78 lakh will work out to be 15% of 78 lakh. 15% of 78 lakh will work out to be 15% of 78 lakh. 15% of 78 lakh will work out to be 15% of 78 lakh. 15% of 78 lakh will work out to be 15% of 78 lakh. 15% of 78 lakh will work out to be 15% of 78 lakh. 15% of 78 lakh will work out to be 15% of 78 lakh. 15% of 78 lakh will work out to be 15% of 78 lakh. 15% of 78 lakh will work out to be 15% of 78 lakh. 15% of 78 lakh will work out to be 15% of 78 lakh. 15% of 78 lakh will work out to be 15% of 78 15% of 78 lakh. Eleven lakh 70,000. Okay. 11 lakh 70,000 gross profit. Then if this is our gross profit, we can get our COGS, cost of goods sold, will be out of 78 lakh, 11 lakh 70,000 is the GP. Out of 78 lakh, 11 lakh 70,000, the gross profit, which is 66 lakh 30,000. Right. Now it further says net profit is 8%. So fine, we can compute that net profit also besides this. Net profit is 8% of sales. That's like 8% of 78 lakh. We can compute the net profit as 78, 8%. 6 lakh 24,000. Net profit is 8% of 78 lakh, which is 6 lakh 24,000. Then sales, GP, COGS, net profit we have. Other information that we have is raw material consumed. Raw material consumed is 20% of works cost. Now, what is going to be the works cost? Understand, whatever COGS we have computed, that is ultimately the works cost. This itself is the works cost. So I can get my raw material consumption. Raw material consumption is 66 lakh 30,000 into works cost is 66 lakh 30,000 into 20%. Raw material consumption is 13 lakh 26,000. Also, direct wages information is 10% of works cost. Direct wages is 66 lakh 30,000 into 10%, which is 6 lakh 63,000. So this information is required, labor and raw material, for the preparation of our P&L statement. Okay, fine. Next ratio that we have from the information is stock of raw material is 3 months usage. Okay, stock of raw material is 3 months usage. So we can get raw material stock as 13 lakh 26,000 into 3 by 12. 3 months usage, 13 lakh 26,000 into 3 by 12, which is raw material stock is 3 lakh 31,500. Okay, then we have the information of stock of finished goods. A stock of finished goods is 6% of works cost. So finished goods stock is 6% of works cost. Works cost was 66 lakh 30,000 into 6%. So 66 lakh 30,000 into 6%. It works out to be 3 lakh 97 800. 3 lakh 97 800 is the stock of finished goods. Okay, then 3 lakh 97 800. That's the stock of finished goods. Debtors collection period is 60 days. All sales are on credit. So let's talk about now the average collection period. right? Or the receivables. So debtors collection period. Debtors collection period is basically debtors. It is average debtors, but there's no information about opening debtors. So whatever is the debtors, we take it as a closing itself. So debtors upon sales into 365. Debtors collection period is 60 days. This is equal to 60. So we know the amount, we don't know the amount of debtors, but we know the sales value. Sales is 78 lakh. Sales is 78 lakh into 365 is 60. So from this, we can get the value of debtors. Value of debtors is 78 lakh into 60 divided by 365, which is 12 lakh 82,192. This is what we have got using the debtors ratio or the debt collection period. Then we have the other ratios. What a fixed asset to sales. We have utilized that already. Now fixed asset to current assets. This is what we will use now. Fixed asset to current assets is 13 upon 11. Now what is fixed assets? Fixed asset is something that we have computed or that's been given to us, right? It's given in the question as 26 lakh itself. We can use that fixed asset to current assets ratio. Fixed assets is 26 lakh upon current asset is 13 by 11. We can get current asset value as 26 lakh divided by 13 into 11 is 22 lakhs. Current asset is 22 lakhs. Okay. Then fixed asset to sale, fixed asset to current asset is used. Then we have current ratio of 2:1. Now, since the current ratio is 2:1, that simply means current asset upon current liability is 2:1. 2 upon 1 is equal to current asset is 22 lakh that we just computed, right? 22 lakh divided by current liability. It means current liability will be 11 lakh. Okay, so we use this ratios. Now the remaining ratios are like long-term loan to current liability. Long-term loan to current liability. We can say long-term debt upon current liability is given as a ratio of 2:1. Therefore, long-term debt is something which we don't know. Current liability is 11 lakh equal to 2. So long-term debt is equal to 22 lakhs. Long-term debt is 22 lakhs. And finally, the numbers that we have is share capital reserves and surplus 1:4. This we cannot compute unless and until we prepare the balance sheet fully. Let's prepare the balance sheet fully first and then we'll talk of these things. Let's prepare a draft balance sheet. In the draft balance sheet, we'll write down the fixed assets, which was 26 lakh, right? Then we had the current asset figure as current asset was 22 lakhs. Now this current asset of 22 lakhs will have raw material stock, finished goods stock, debtors, and some cash and bank balance. We have the raw material stock available. Raw material stock is stock of raw material. We computed it, right? Yeah. 3,31,500. Finished goods is 3,97,800. Raw material stock 3,31,500. Finished goods stock 3,97,800. Debtors, just computed debtors also, right? Debtors is 12,82,192. And then the cash, so 1,88,000, not 1,88,000. It is yet to be computed, right? Then share capital, we have got equity share capital. We've got the reserves, long-term debt, current liability. Current liability is 11 lakh. Long-term debt is 22 lakhs, right? Now, how do we go about the remaining things? We have like equity share capital, reserve spending, and the cash balance spending. Now, obviously, that cash is going to be a balancing figure because all of them should be totaling to 22 lakhs. So the cash will work out to be 1,88,508. Now, we know that equity share capital and reserves is both should total up to, because it should be tallying with each other, right? When you're going to tally them, it should close at like 48 lakhs. 48 lakhs. The equity share capital and reserves should be 48 minus 33, that's 15 lakhs. Now you can look at the question and say that the ratio between share capital and reserves surplus is 1:4. We have like 1:4 ratio. When we have this as 1:4 ratio, reserves and surplus will be 12 lakh and equity share capital will be 3 lakh. Right? This is the balance sheet that we were looking at. Now, apart from balance sheet, the question asks us to prepare even the P&L. Even the P&L needs to be prepared. A P&L can be similarly prepared by using the information that we have obtained. You can prepare the P&L in the normal format, also in the T format, or just normal thing also. Say sales of 78 lakh. From that, we are going to reduce the COGS, right? Now in that COGS, we have raw material consumption. Raw material consumption is 13,26,000. We have computed, right? Raw material consumption is 13,26,000. Then what wages? Wages also we have computed 6,63,000. And we know that our COGS that totals up to cost of goods sold totals up to over here, see, works cost 66,30,000. We want that to be 66,30,000. So raw material, wages, and obviously whatever is balancing, that is probably some manufacturing overheads. You can say manufacturing overheads will be 66,30,000 minus 13,26,000 minus 6,63,000. So overheads is 46,41,000. And subtracting that, we will have a gross profit 11,70,000. right? 11,70,000. And then we directly have the net profit figure, which we have computed as 6,24,000. Net profit is 6,24,000. There's no other information available to us. So this will be like a balancing figure, which will say that admin and selling expense. Okay. Admin and selling expenses will say balancing figure. It should be like 5,46,000. Yep. Yep. That's the solution to question number 3. One more question was asked. I think, what was that? Question number 3. Question number 3 is what I have done. Test your knowledge. Question 8. Okay. Question 8. Okay. So it has furnished the information that in the year ended 31st March 2020 and 31st March 2021, net profit ratio is 8%, GP is 20%. We are required to prepare the balance sheet. Okay. The balance sheet needs to be prepared. Let me solve this question 8 now. We have asked for it. Yeah. Question 8. It says following information, share capital, opening and closing is given, reserves and surplus opening closing and long-term loans are given, opening and closing. Net profit is 8%, GP is 20. You see, all these are numbers, all these are percentages. So I need some number to solve it, right? Debenture 90%. Assume ignore taxation, assume 360 days. Company holds cash equivalent to 1.5 per month. Net profit ratio is 8%. Now you need to look at the reserves and surplus. So first we'll say change in reserves. Change in reserves is basically the net profit that you would have made in that year. If your reserves have increased, it means you have made the profits. Right? You would have incurred the profits. The profit will be 25 lakh minus 20 lakh, which is 5 lakh. So 5 lakh is the net profit or the change in reserves. Now, this net profit of 5 lakh, when we say net profit ratio 8%, that 8% is basically net profit upon sales. It's equal to 5 lakh upon sales, which will give you a sales value of 5 lakh divided by 8%, 62 lakh 50,000. Then cost of goods sold. Cost of goods sold will be sales less the GP margin. So sales is 62 lakh 50,000 and GP is basically 20% of 62 lakh 50,000. 2,50,000 to 20% minus. So that's like COGS is 50 lakh. What the COGS is 50 lakh. Now all my numbers are based on that. Then stock turnover with respect to cost of goods sold, they're saying it is 4. Fixed asset, long-term loans have been used to finance 40% of fixed assets. Right, so long-term loans are used for 40%. So we have this number as long-term loan to fixed assets. Long-term loan to fixed assets is 40%. Therefore, long-term loan, we know it is 30 lakh as given in the question. On fixed asset is 0.4. So we get fixed asset as 30 lakh divided by 0.4. That will translate to 75 lakh. Now, stock turnover with respect to cost of goods sold. The COGS upon stock is given as 4. We have COGS as 50 lakh upon stock is 4, and therefore stock will be equal to 50 lakh divided by 4, which is 12 lakh 50,000. Then debtors represent 90 days of sales. We have sales figure as 62 lakh 50. This is a full year sale. So whatever debtors you have, that is 90 days of sale. And the question says you have to take 360 days in a year. 62 lakh 50 into 90 by 360. That should be like 15 lakh 62. 500 is the debtors amount. Cash, the company's question says the cash is 1.5 months of cost of goods sold. So 1.5 by 12 into cost of goods sold. Cost of goods sold is 50 lakh. 1.5 by 12 into 50 lakh. 50 lakh to 1.5 by 12. 62, 6 lakh 25,000. The cash balance. I think we have done almost here. Almost everything is done. I need to fill up just the balance sheet now. Share capital, reserves, long-term debt, creditors, fixed asset, debtors, stock, and cash. The what cash recently calculated 6 lakh 25,000. Stock is 12 lakh 50,000. Debtors 15 lakh 62,500. Fixed assets also we have computed 75 lakh. Then share capital reserves. We got this. Anyway, share capital and reserves are already there given in the question. Share capital is 40 lakh. Reserves is 25 lakhs. Long-term debt is what we have computed. That's given, right? 30 lakh is given there. And then the creditors are, but obviously going to be the balancing figure that should tally on balance. Creditors balance should be becoming as 14 lakh 37 5. Okay, gross profit. Sudhanshu is not equal to EBIT. Gross profit and EBIT are different figures. EBIT is earnings before interest and tax. So from gross profit, you subtract other administrative and depreciation and selling expenses, and then you get EBIT. Okay. So with this, we'll just take a break right now. After break, we'll take up questions on capital structure from the handout, the notes that I've shared. Okay. So let's take a break of 10 minutes now, guys. Welcome back, guys, after the break. Uh, let's do some questions of capital structure in this remaining part of our session. Let me just open up. We have done some of the questions from here. Uh, let us do some more questions on this sheet itself. We've done like question. Let's do this question number 8, guys. This question 8. Topco Limited, an all equity finance company, and is considering the repurchase of 200 lakhs equity to replace it with 15% debentures of the same amount. Current market value of the company is 1140. So can you tell me what is this 1140? Is it value of equity or is it value of debt? 1140, is it value of equity or is it value of debt? That price? What is this 1140? Is this value of equity or value of debt? Yep. It's definitely the value of equity because it's an all equity company, right? Since it's an all equity company, there's no debt involved in it. But the company is now contemplating to replace some of its equity with the debt amount. So current market value of company is 1140 and its cost of capital is 20%. Earnings before interest and taxes are expected to remain constant in future. EBIT is going to remain constant as it has been earlier. Its entire earnings are distributed as dividend. Applicable tax rate is 30%. You are required to calculate the impact of the following on account of the change in the capital structure as per hypothesis: market value of company, cost of capital, and cost of equity. It is solved, but still, I'll just solve it fully in the written format for all of us, because it will help us in understanding it or grasping it in a better way. Okay. Coming to this value of equity. In the first case, we have the value of equity for this Stopco Limited, which is the first case as the original and the new value. In the first case, we have value of equity as current market value of the company is 1140. The value of equity is 1140. Value of debt, we don't have anything. But yes, the value of the firm will translate to be 1140. K is cost of capital is 20%. So entire K is 20%. Cost of debt is not applicable. So what's the EBIT that we have in this question? EBIT is expected, its earnings before interest and tax is expected to remain constant in future. How will I know the EBIT amount, guys? Tell me. How will I know the EBIT? Because there's no information about EBIT, but they're saying that whatever is EBIT that will remain same, that remain constant in future. So what? How am I going to get EBIT in this question? Anyone tell me? How can we get the EBIT? Yep. Value of firm divided by KE will be EBIT. Um, Basically, we can get EBIT by backward calculation. Uh, we know that cost of equity is 20%, right? So cost of equity 20% means we know value of equity is PAT upon KE. If I want PAT, I can simply compute it as value of equity into KE. So I can get this PAT figure over here as 1140. That's the value of equity into 20%. So 1140 into 20%, that will come out to be 228. So if that's 228, then you do the reverse calculation. So if the PBT is 100, so this will be 30 and this will be 70. What will be that cross multiplication number? To do that simply cross multiplication, you'll get the PBT figure. Right? The PBT figure is 325.7. No interest. So EBIT is also going to be 325.7. Right, guys? Yep. Yeah. So value of the firm and value of equity same. So we got this EBIT as 325.7. Now, this same 325.7 is going to be the EBIT even for the new scenario. It's just that, as the question says, we need to have some amount of debentures in our balance sheet. So we are going to buy back 20 lakhs. We are going to buy back 20 lakhs of equity and replace it with debentures. So value of debt will become, 200 lakhs. Now on this 200 lakh, this is going to be at a rate of 15%. Cost of capital for equity is 15%. Yeah. So 200 into 15%, we say interest will work out to be 30. If this is 30, profit before tax will be 295.7. And after payment of taxes, PAT will be 207. That will be 207. Okay. So now PAT is 207. There is a tax applicable in the given scenario. Can you tell me what will be the value of the firm of this new entity? By the way, original entity was unlevered. New entity is levered. So how do I get value of firm of levered entity? How do I get value of firm of levered entity? Yep, guys, tell me. How do I get the value of firm of levered entity? Any formula that we have got for value of firm of levered entity? MM model, MM with tax, We have a formula, right? You remember we have just done it in the previous class. Yep. Levered plus unlevered. Rahul, I think you have not attended previous class, and therefore you're asking what is levered and unlevered. Yep. So value of firm, we know what happens in this case. We know value of a levered firm is value of unlevered plus debt into the tax rate. Correct? Perfect. So this works out to be like 1140 plus debt is 200 into tax rate of 30%. This will work out to be 1200 as the value of the firm. Overall value of the firm is going to be 1200, and we can get the value of equity by simply looking back and seeing that this is 1000. So once I have this as 1000, we know that PAT is 207. So K is going to be 207 divided by 1000, which is 20.7%. And the cost of debt is going to be, so cost of debt is 15% rate, 15% giving the effect of after tax effect. Tax saving 1 minus tax rate. So that's 10.5%. Now, we have the cost of debt, we have cost of equity, we have value of equity, value of debt. Can you get the EBIT, guys? Sorry, can you get the overall cost of capital, KO? Can you compute KO over here in this case? Calculate the KO, guys. Calculate the KO. One of the ways of computing KO is writing down equity and debt value. Equity value was 1200, debt value, sorry, equity value was 1000, correct. Debt value was 200 and total it was 1200. Cost of capital is equity has got a cost of 20.7 and 10.5. 20.7%, 10.5%. Then you write the weights, write the product, and take a total of it. And the total that you get is what we say as the overall cost of capital KO. Right. So get this KO. Get this KO. EBIT calculation. EBIT calculation is a backward calculation. You have PAT. PAT is like 20% is KO. Value of firm is 1140, or value of equity was also 1140. 1140 into 20%, that's your PAT. Then you go backward. This is 70%, 30%, 100%, and then going backward, you get 325. Yep. That's the backward calculation. I think we have done a few questions like this the last class also, where we computed the EBIT by doing backward calculations. Yep. What's the KO, guys? KO is 18.99. 18.99%, guys. Right? You can compute KO by another formula, which is a shortcut also. That's EBIT 1 minus tax rate upon value of the firm. That will also give you the same thing. For example, if you take EBIT as 325.7 into 1 minus 0.3 upon value of the entire firm, which is 1200. You can check the numbers. See if you're getting the same almost 19% as the EBIT, as the 19% as the KO. Yep. You're getting this same answer. You can use the shortcut formula for KO also instead of doing it fully like in the form of a weighted average. Getting the same? Okay, perfect, guys. Let's try out um, more questions. Let's try out this question 9. Look at this question 9. Alpha Limited and Beta Limited are identical except for the capital structure. Alpha has 50% debt and 50% equity, whereas Beta has 20% debt and 80% equity. All percentages are in market value terms. The borrowing rate for both companies is 8% in a no tax world. And capital markets are assumed to be perfect. If you own 2% of shares of Alpha Limited, what is your return if the company has a net operating income of 3,60,000 and overall capitalization rate KO is 18%? What is the implied required return on equity? Beta has the same net operating income as Alpha Limited. And what is the implied required equity return of Beta? Why does it differ from that of Alpha? Okay. So now, first of all, we have to assume over here, unless and until I make this assumption of net operating income approach is being used and that the value of alpha and value of beta is same, or KO of alpha and KO of beta is same, I cannot proceed with the solution. That's the assumption that we have to take in this typical question. Okay, so they are identical except for capital structure, and they say that one company is having debt, the other is not having any debt. Borrowing rate is also same, and they're asking us what is the required return on equity. Now, when we are being asked what is the required return on equity, it means equity return is going to differ as per the rate of or as per the proportion of debenture rate, and therefore we say that it's going to be the same. It's not that is we are using the net operating income approach. The logic for assuming this net operating income approach is the question asks us what is the implied return on equity. Now, when you say implied required return on equity, it means you need to compute it, which means it is going to differ as per the debenture, as per the amount of debt. So equity rate changes along with debt only in case of net operating income. If you can recollect that, we have discussed that earlier also, right? So let's try to solve this question now. So already solved, but then I want you to look at the procedure, how we solve it. So I'm just erasing this portion. Okay. Now, with regards to alpha, the debt equity ratio that's provided to us, the question is 50-50, and for beta it is 20-80. Okay. Let's write it as debt equity 50-50 and 20-80. Okay. With other information, we have the cost of debt as cost of debt is 8% in both cases. Okay. Then overall cost of capital. What we have is KO is 18% overall cost of capital. So since you are assuming it as net operating income, it is going to remain same. Now, coming to EBIT, they say that the net operating income is 3,60,000. So irrespective of your capital structure, your EBIT is going to be 3,60,000. Value of the firm, we know it is EBIT upon KO. So that's like 3,60,000 divided by 18 is 20 lakh. That's going to be also same since we are assuming it as net operating income. Now, as we have the value of firm as 20 lakh, we need to know what is the value of equity. The debt equity ratio is 50-50. The value of equity is going to be 50% of it. It is 10 lakh. And even the value of debt will be 10 lakh. Value of equity will be 20 lakh, 80%. So that's going to be value of equity is 16 lakh and value of debt is 4 lakh. Right? Then since it's a no tax scenario, your profit before tax and profit after tax is one and the same. And how do we get the profit before tax over here? It is EBIT minus cost of debt into value of debt. Right? So that will work out to be EBIT is 3,60,000 minus cost of debt is 8% of debt is 10 lakh. 3,60,000 minus 8% of 10 lakh, which will be 2,80,000. This side it is 3,60,000 minus 8% of 4 lakh. This 3,28,000. Right? The PAT is this. Now, if I want to talk of KE, what is the cost of equity over here? We can get PAT upon the value of equity. It is 2,80,000 upon 10 lakh. 2,80,000 upon this 10 lakh. That's 28%. Then we have 3,28,000 divided by 16 lakh. 3,28,000 divided by 16 lakh, which will be 20.5%. Right. Now coming to the next part, the question says if you own 2% of shares of Alpha Limited, what is the return if the company has a net operating income of this business? Okay. So you are owning 2% of the company. So it means your investment is 2% of the value of equity 2% of value of equity, it means 2% of 10 lakh, which is 20,000, right? And uh, then if you own 2%, what is the return if the company has a net operating income? So and so. Now, you are investing like 20,000 in the company, and you are also going to have 2% share in the company profits. The company PAT is 2 lakh 80. On that, you are getting 2%, which is 5,600. Okay, so 20,000 share in PAT is 5,600. Return that you are getting is like 5,600 upon 20,000. On an investment of 20,000, you have a PAT share of 5,600, 28%, which is same as this. Okay. And for beta also, we can say so beta is also the implied K is 20.5, and that will be the same return which as an investor you are going to earn. Okay. That's a pretty simple question. Look at the queries if there are any. Point difference is coming. Is it allowed to do second method for Q? Yes, here you can do the second method. There will be some rounding up error, but never an issue. That's okay. Okay. Then now next question that I want to do is question number 11th. Question number 11th. Let's begin. Question 11. Question 11. One third of total market value of Sangmani Limited consists of loan stock, which has a cost of 10%. Another company, Samsui Limited, is identical in every aspect to Sangmani Limited, except that its capital structure is all equity and its cost of equity is 16%. According to Modigliani and Miller, if we ignore taxation and tax relief on debt capital, what would be the cost of equity of Sangmani Limited? Now, if there is no tax, if we ignore the taxation and any tax relief over there, then in the absence of any tax, we can say value of both levered and unlevered should be one and the same, right? Let me just look at this question 11. See, value of the firm one third of total market value consists of loan stock, which has a cost of 10%, and they say uh, another company in every respect except its capital structure. Now there is a loan stock of 10%. Some money. Let us assume the value of firm to be uh, 90,000, which out of which we say one third is debt. They have taken purposely 90,000 so that value of debt becomes 1/3, which is 30,000. Okay, so this is like 1/3. So we have the value of equity as 60,000. Cost of debt is 10%, right? And except that its capital structure is all equity and its cost of equity is 16%. So Stamford Limited has everything same. So value of firm will remain same 90,000 because in the absence of any taxation, value of both the firms remain one and the same. And since there is no debt, value of equity will also 90,000. Cost of debt will be not applicable, but cost of equity is 16%. But since we are talking of net operating income approach without taxation, which is the approach, we say that it is going to remain same. So KO is going to remain same 16% because in case of net operating income approach, in which we don't have any tax rate applicable, we say the overall value of the firm and the overall cost of capital remains one and the same. So we get this as 16%. Now this 16% should be ideally the KO ratio, and that KO ratio is value of debt into cost of debt plus value of equity into cost of equity. So overall cost of capital is 16%. That's equal to 1/3 into 10% plus 2/3 into KE. Now we don't know what this KE is. We just need to solve this equation to get the KE of 19%. Let's go through the solution of the KE for a minute, guys. $90,000 is what I have assumed, na, bhai? I've assumed it's 90,000 because it's a divisible by 3 number. So 1/3 to make it as 1/3, I've taken it as 90,000. You can take any number. You can take 9 lakh, maybe 18 lakh. Make sure it's divisible by 3. Okay. Okay. Rahul, do we have a separate formula for K in case of leverage form? In case of leverage form, yes, we do have a formula. We have discussed that in the last class. Someone is saying, please explain the secondary arbitrage again. Sure. So this is the secondary arbitrage, guys. Which is secondary arbitrage. Company A is an unlevered, company B is a levered firm. Unlevered firm or levered firm doesn't matter, sir. EBIT is going to be the same 20,000. Interest will differ. Interest on A, since it's a unlevered firm, there's no interest. Since it's a levered firm, interest is 7,000. And we have PBT or PAT as 20,000 and 13,000. Now, KE is, let's say, 10% and 18%, and cost of debt is 7%. And now, based on this, we compute the value of debt, which will be 7,000 upon 7%, 1 lakh. Equity is 2 lakh, is 72. And value of firm will be 2 lakh. And overall value of the firm over here is going to be, guys, like total of these two. So how do you get this equity value? Equity value is your PAT divided by 18%. Now, out of this levered and unlevered. Tell me which of the firm is overvalued and which is undervalued. Which of these two firms are overvalued and which one is undervalued? Yes, guys. Overvalued is B. Is overvalued B? Okay. Yeah. Unlevered firm is overvalued and levered firm is a undervalued. So now the investors will switch from unlevered to levered. Earlier case, we said that investors will be switching from levered to unlevered. That was a primary arbitrage. Secondary arbitrage is when investors start switching from unlevered to levered. Right? So now, with an investor switching from unlevered to levered, how is that activity going to happen? Let me just recap it for you. So let us assume an investor who is having 10% stake in A, 10% stake in company A, and he wants to switch to B. So of course, he will first evaluate whether he's getting something additional return or what. So when he's going to sell 10% of his share in A, he will get 10% of this 2 lakh. So 10% of 2 lakh is 20,000. So 2 lakh into 10%, that's 20,000. So cash that we received on sale of 10% stake in A is 20,000. Right? Cash received on sale of that 10% stake is 20,000. Now, with this 20,000, we want to make an investment in B. But remember, investing this 20,000 in B is not going to match our risk profile. Because when we were invested in A, it was only an equity entity. Now, when you're going to invest in B, you need to invest in equity as well as in debt. Because if you take investment only in equity, you are not matching the risk profile. Because when you invest in equity, there is a background debt that comes along with you. If the company is not able to honor you, company is not able to honor the debentures, then the debenture holders will take away the assets and ultimately it will lead to loss in the value of your equity. So risk is not same if you just take equity from here and invest in equity over here. So we need to invest in equity as well as debt. So using the cash available, we need to invest for acquiring 10% stake in equity as well as 10% stake in debt. Right? So I need full 10% power in that new company. So the investment that I need to make is 10% of 72,222, which is the value of equity, 10% of 1 lakh, which is the value of debt. The total investment that you will make is 17,220. So you realized 20,000, but out of that, you will be making an investment of just 17,222 in that other company because the risk has to be matched. 10% stake has to be matched. So earlier I was having in A 10% stake, in 10% stake in A. Now when I'm switching over to B, I should be also having 10% stake there also because I liquidate 10% stake from one place and I put additional stake over there. Earlier I was having 10% power. Now if I have 15% power, definitely my income is going to be higher. So I want to compare and see with the same level of stake, will I be able to get a better return or what? And therefore we acquire 10% in equity and 10% in debt. Okay. So investment made is 17,222 and we still have this surplus cash available with us. Okay. So now, what is the income receivable on investment after switching? On equity shares, you have like 13,000, 10%, and on debt, since you acquire 10,000 amount of debentures, on that you will get 7%. The total income is 2,000, right? So 2,000 and issue on surplus of course, you will get the income on this surplus also, right? Now, income before switching was just 2,000, sir. So before switching, it was just few thousand. Now over here, you have 2,778 extra income also on extra income on this investment. Of course, after switching, you are going to get 2,000 plus something. Therefore, you should switch over to that new entity. Yeah. Raghavan is asking, sir, debentures are issued how already subscribed in full? How they get 10%? Raghavan, debentures are issued, they are subscribed in full, but they are traded in market. So I can buy the debentures from the market. Okay. One last thing that's left over in this case is the guys trade-off theory, and pecking order theory. Okay. So let's have a look at what these theories are. Okay. Trade-off theory. Uh, if I ask you, taking debt uh, is good or bad, your answer should be, sir, it depends. It depends on what? It depends on the return that you are generating, right? And also how much debt you can really sustain. Okay. So trade-off theory says we need to offset the cost of debt against the benefits of debt. It first says that there is an advantage of financing with debt. First of all, the cost of debt is lower, and also you get the tax benefits of debt. But apart from that, there is also a cost of financing with the debt. Cost of financing with the debt. Now, what will be the cost of financing? See, when you take a debt, you are undertaking a fixed obligation of payment of a fixed amount at regular intervals to your creditors. So every month you need to pay the EMI, or every half yearly you need to pay some amount of interest. So that pressure or that sort of stress will be always there on you that I have to pay this month. So in case you need further money for investments, that won't be possible for you. And that's what we mean by the cost of debt, cost of financing with it. So what sort of cost do we have, sir? Cost of financial distress. What's the financial distress? So next month, I have to pay an EMI of, let's say, 50 lakh on my loan. But also I have a wonderful investment opportunity available, which requires an investment of 50 lakhs and on which I can earn great return. But since you have already taken debt, you cannot invest anymore because no one is going to provide you additional debt. So there is a distress on you. There is a cash crunch that you are facing, that in spite of having good returns, I'm not able to sustain in a financial world because there's a financial distress that follows me. Every now and then I'm under the stress that I need to pay a fixed amount. So that obligation of fixed amount payment is something which is financial distress. And when that happens, you may be having wealth, but then you don't have the liquid cash, and that will cause bankruptcy and some non-bankruptcy cost also. Like if you are defaulting on your loan, understand the confidence, the the loyalty that the staff or the suppliers or the customers have on you, they may simply uh, leave you and they'll say that this company is no more reliable. There may be a case that staff may be leaving, suppliers demanding for early payment, or bondholders or stock shareholders infighting. So all these things may happen once the financial distress sets in. Okay, so there is some advantage and there is some disadvantage also. Now, generally, in the initial stages, what happens is uh, the benefits of debt outnumber the cost of debt. The benefits of debt outnumber the cost of debt, and that's something which is good. But as and when you take more and more debt, as and when you take more and more debt, uh, that benefit starts declining, right? So marginal benefit of further debt increases, marginal benefit of further increases in debt declines as the debt increases while the marginal cost increases. So benefit that you have, value of the firm will keep on increasing at a point of time. But then there is this cost of financial distress also. So this particular portion, it talks of the benefit of the savings, and this portion starts increasing. And this portion is that's the optimal debt level. Below this level, you can sustain, there is no issue. But beyond this level is not sustainable, sir, because the cost is going to be more than the benefit. That's like if you take more and more debt, there will be more financial distress, more pressure on you to pay fixed obligation, and that will lead to financial distress. Okay. Then next one is a pecking order theory. Hiral is asking, sir, have you uploaded all the sum solutions for our reference? Yes, Hiral, I have uploaded. You can look into the file, solution file in the assignment section. I've uploaded these notes. Pecking order theory. This also talks about in what way the finance managers raise capital. So this theory states that the firms prefer to issue debt when they are positive about future earnings. Equity is issued only when they are doubtful and internal finance is insufficient. So this is a this is a typical scenario that we observe, that when you are very positive about that wherever I'm going to put the money, that's going to provide me superior returns, that's going to provide me great returns. If that's the case, then you are going to issue debt. Or you can say you will raise the funds by way of debt, by way of loan. You will not prefer to have your own equity investment. Okay, you will not prefer to have a equity investments. So this theory is also of the same opinion that if the managers are thinking that a typical project is very much profitable, they will put their money into that investment, into that project, but the money will be raised by way of debt. So when are they going to issue equity? Only if they are doubtful about that project. Okay. The pecking order theory argues that capital structure decision affected by managers' choice of source of capital that gives higher priority to sources that reveal the least amount of information. So this theory says managers are going to raise funds from those sources where they need to make minimum disclosure. Tell me, where are you required to give minimum disclosure? When you issue debentures or when you issue equity shares? That is, when do you have to announce it publicly to a great extent? When you want to issue equity shares or when you want to issue debentures? Yeah. When are you required to give more information? When you're about to issue the debentures or when you're about to issue the equity shares? Of course, in case of equity shares, right, you have to file a prospectus, you have to go to SEBI, you have to file your documents with ROC. A lot of activities, a lot of disclosures needs to be done. So that equity source of funds is a least preferred, or I can say lowest priority preferred source of fund. Managers will never go for that because of very great degree of disclosures being given to them. Right. So managers generally say that we don't want to disclose our business secrets. So they will always go for debentures or bank loan, in which public information is shared to the least possible extent. And that is what is identified in this pecking order theory. They say that managers prefer to raise funds to those sources in which the least amount of information is given. Pecking order theory suggests that managers may use the various sources for raising funds in the following order. First of all, managers would like to use the internal finance, that is, the money that they would have saved in the business, or they would be having the form of retained earnings. They might have parked some of their funds in liquid assets, so they may like to first use that because using those funds require no information to be given to the investors or to the outside world, right? That's the first thing. Second, if this internal finance is not available or this internal finance is insufficient, then they will use the secured debt and unsecured debt or hybrid debt. They'll go for debenture option. Hybrid debt is basically convertible debentures. Okay. And if this is also not sufficient for us, then we may go for the equity shares as the last option. That's the pecking order theory. Order. It means first internal finance, then debt fund, and then the equity shares. Therefore, we say that's as a pecking order theory in which you are going to issue debentures in a typical order. Okay, that's a pecking order theory. Okay, Raghavan is asking, please explain the graph again. Okay, see Raghavan, as you take more and more debt, without any level of debt, value of firm is going to be this. See, this is the value of the unlevered firm, and this is the value of the levered firm. Unlevered firm will have a constant value irrespective of you take debt or not. But the levered firm will definitely have a higher value, but that value will keep on increasing because of two things. One, there is a benefit of the income tax, benefit of the lower cost of debt, but there is also a cost involved in it. So as you move further, the benefit starts slowing down, and after a point of time, it starts declining. The benefits will start declining, and the cost of distress, the pressure of paying, paying fixed installment will take over, and after that, the value of firm will start declining. So this theory suggests that we should look for that level of debt at which value of the firm should be maximum. Internal finance means the surplus profits, past profits. Okay. Agency cost is the cost that the company incurs over their managers, because in case of company, understand that in case of company, the managers are separate and the owners are separate. So the owners need to pay some X amount to the managers so that they work for the company, and that's the agency cost that we have. Right. So along with that, there may be some conflict of interest also. So that conflict is again a sort of agency cost that the company has to pay. Okay. With that, we are through with today's session. I'll wait for a minute in case if you have any queries. Otherwise, we'll call it a day. Any queries, guys? How to find optimal debt level? Smita, you need to check it with the traditional approach. At every level of debt, you will say what is the value of your firm. And wherever your value of the firm is highest, that is the maximum level of debt you will take. Okay. Any other queries, guys? No? No queries? Under trade-off theory, value of levered firm is showing traditional approach and value of unlevered approach is showing no approach. Yeah, Shreya, you can say in that sense. Okay, guys. So there's no other query left out. So let's stop here for the day. See you on Thursday. That will be our uh, last session. Okay. MCQ won't be there, Hiral. Hitesh is asking hybrid debt. Hybrid debt is convertible debenture, Hitesh. Okay. So let's stop here for the day, guys. Bye bye. Take care and enjoy. See you on Thursday once again for the last session. Bye, guys.